Hello and welcome to Trading with Technical Indicators. My name is James Boyd and happy Green Shirt Monday. Today's date, November 10th. Here we go. Got 2 weeks to, about 2.5 weeks to go to Thanksgiving. So hopefully you're getting your watch list properly prepared. We'd like to welcome all of you here today. We got Scott Luck, Kevin, Luke, JP, Rocco, GH, GT, JR, and many others. We also have Rachel Dasher with us in the chat. We welcome her. Just real quick, you can find Rachel and myself on X. There's my handle there. Feel free to check it out. Rachel will post hers actually in the chat, so that way you can just click on it. And quick reminder that with what we discuss here today, the information we discuss and bring up, it's done for general informational purposes only. Should not be considered an individualized recommendation. Also remember that options carry high level risk and are not suitable for all investors. When we talk about examples, we will do those in the Paper Money software-based version, and that's done for educational purposes only. When we also bring up examples, we want to really focus on the risk, okay, and strategy selection. And this is really big because investing involves risk, including loss of principal, especially like what we saw in the last couple of days, where you could have drawdown. Now, also remember that when we talk about examples, we're going to look at some of the principles of technical analysis. With the recent pullback in the market, our focus is really going to be talking about divergences. We'll also talk about diagonal breaks of resistance and change of short-term trend. Now, to do that, let's go ahead and just take a quick look at where the markets are just briefly. Now, first thing we actually said we want to look at when we wake up in the morning, regardless of the time, is where's the VIX? Well, if the VIX is, for example, down, leads us to believe or think that maybe the equity markets are higher. Well, take a look. Here we are at 17 and change. Last week we were what, 21-ish? Somewhere in that ballpark. And this is where we kind of like to see it as bullish, right? We like to see that the trend actually goes trend one on the VIX. Last week we actually saw trend one, okay, in the S&P, in the NASDAQ, in the Russell, and also in the Dow Jones. This week we actually kind of have trend fours back. What does that really mean? Well, it means that we've kind of tried to snap back up to where we were after hitting a fresh new low. Now, the thing that's kind of standing out a little bit, if we're talking about maybe an index that's doing something a little different, is the Russell. But we also kind of see that we'll also include with this the SOX, which has had a pretty big return. We've also seen a big change this morning in gold, and we've also seen a big change in silver. Did anyone else see that? Okay. Now, comment came in as, James Jackson is actually not on this watch list. How is he doing? He's doing a lot better than last week, that's for sure. Okay, and I'm glad. I call him my little buddy. Anyway, kind of funny. Now, just real quick, now, here's the deal. Every move, so when we actually went down, right, we went lower low, lower high, lower low, right, and then we come back up. I'm going to tell you, in the 25 plus years that I've done this, every time when the market goes back up, you're always thinking the exact same thing. How do we know it's going to go up? Now, you got to remember something, is that you can get short-term pullbacks that are falling down to rising, let's say, moving averages like the 30, like the 50, like the 100, like the 200, and so on, okay? So the biggest actually thing is nobody likes your short-term pullback because you kind of get uncomfortable, but that short-term pullback could actually just fall into maybe where intermediate investors are trying to get in, okay? So those intermediate, and I'm also going to include long-term investors, they are trying to do a bounce setup. So in our discussion here today, we're going to look at the shorter term trend. We'll also talk about that intermediate long-term bounce by looking at the 30, 50 period moving average to see if that's what's happening, okay? So it's not a good idea only to look at one time frame. You want to kind of probably have 2 or 3 that you're really looking at, okay? And we'll show that. So first off, let me kind of just take a quick peek at the VIX, and then we're going to fast fire through a couple. When you actually look at the VIX in general, remember, we don't want to see the VIX have green shading. We want to see have red shading. We do not want to see the moving averages actually on the lines themselves be green. We want to see them be red. Today's a start. If we actually see an upper shadow on the VIX, you actually probably have a lower shadow on the S&P 500. Now, if we pulled up the SPX, you're going to see that. Now, remember, think back to what the VIX looked like. Okay, the VIX upper shadow, S&P 500 lower shadow. Now, just because I was at the office doesn't mean I wasn't watching. I mean, I was at a wedding, but it wasn't me getting married. Okay, that's why they came up with mobile. Okay, so a little push here. Now remember, sometimes when we actually fall down, we'd always like the first term level to be support. But like we've realized is sometimes that level is not the support and it falls down inside the channel, falls down to the next level. And so here we are again kind of seeing that play out. Again, it would have been nice to hold the 67.48, but sometimes it doesn't happen. And you actually see a little bounce and it's at least getting back above the 10-period moving average. We have not been above the 10-period moving average. I'm talking about closing above the 10-period moving average since this date, actually right here on 10/29, which seemed like it was a year ago. It really wasn't, but it seems like it was after you pull back. Now, if we actually pulled up the SOX just real quick, where we actually got a pretty big push was in the SOX. Can you name any SOX semiconductor stocks that we might take a look at here today? Are there any that went up and showed relative strength from last week's movement? Anything? Anything? This is your chance. Now, we'll also bring up the NDX. Looks very much like the S&P 500, okay? The Dow Jones itself, pull that back up. There we go. And if you look at the Dow, kind of in between the moving averages, okay? I want to go look at the Russell for just a sec. It's above the 20 period. So the smaller caps here leading in the fact that they have gotten above the not only the 10, but the 20. Now, I want to go back just to only one, just real quick, and I want to look at kind of what we see on this longer term. I'm going to go back to a daily chart first, okay? And what you're now going to notice is if I kind of bring this down and I'm going to zoom in for just a moment, and I'm going to take these lines off. I mean, in a trend itself, we know that trend is not just short term. If we zoom in on this, and I'll back this off for just a second, it doesn't really look like anything majorly happened. Kind of looks like we fell down to the 30, this is the 50 period moving average. And you're going to see that, remember, for some investors, that's where they're trying to get in. Now, a lot of people say, I want a pullback. I want a pullback. Well, you finally get a pullback, and then you ask yourself the same question. Oh, I'm going to wait to see what happens. I'm going to wait for it to get a new high. We make a new high. Now I'm too late. Now I'm waiting for a pullback. And it's just a cycle of just like, I'm not going anywhere. You got to remember something, whether you buy at the brand new high, you buy on the dip, there's risk with every entry. So this is why some investors will say, what am I comfortable in risking? And they just take the risk, okay? And they look and see, can they get those trends to play out? That never changes, ever, okay? I've seen markets go straight up and you're always, well, how do you know it's going to keep going up? You can't see the future, okay? Now, you'll get some guy on the internet that he can say he can see the future. He can't, okay? Now, the big thing is what you're now going to notice is why is it orange or orange? Well, because it kind of is looking at the past graph, you'll kind of see that it's up near this area of resistance. Now, remember, if it goes up again tomorrow, it could probably turn back green as it's kind of getting out of this little area of resistance. Now, what does this look like on the weekly chart? And the weekly chart is critical because if you can get the weekly chart showing the strength, well, what do I mean by that? Well, if the price is above your 10-day, or in this case, 10-week exponential moving average, you know, you could say, well, I'm nervous, but you could see that intermediate to longer term investors who are looking at this chart, they're not as nervous as your neighbor, me, whatever. You didn't see anything break. We didn't trade really that far below the 10-week moving average at all, okay? And by the end of the week, we pushed right back above it. Okay. Yeah. Now, here's the deal. So let's go back to this real quick. I want to fast fire sectors. Now, remember, if you're really getting a move, there is kind of a grade we would kind of be thinking about. If we're getting a move, we would want to see what sector's getting the push. Now, I'm going to tell you right now, if you're nervous Nelly, okay, or nervous JB, you want to kind of say if the market is bouncing back up, what sector should be leading the charge? Well, number one, it better be coming through technology. The highest percentage gain should be, or could be, I'd say in the top two, would be technology, which is a decent push here today. We would also see number two would be the consumer discretionary sector. These two should be the top two. We'll look and see if they are just a sec. And if we said, well, what's something else we'd be looking at? We'd be looking at, let's say, base materials. We'd also be looking at energy. And probably the fifth one would actually really, in this case, be don't sleep on energy. And what you're now going to notice is the financials. Probably, if we look at those are the top five. We want to see that those are moving. It's not that the utility staples, healthcare, real estate are completely down for the day, but on a percentage basis, they should be underperforming. When we actually look at the list real quick and say, what do we got? Now remember, I include stocks right here. I include gold right there. Let's take those out. And what you're now going to see is we got tech. There it is. There's discretionaries. There's base materials. Communications we can include as well, which I didn't bring up because it's not as strong as uptrend as some of the other things we've been seeing. There's energy. Probably the one that the dark horse on the outside is going to be yours truly, healthcare, which has been an ascending triangle. Okay. We said price patterns are the best when they're done being in the price pattern and they finally break up or down. All right. Now, so when I go back to just real quick sectors, we want to kind of, so first of all, when we talk about the indexes, we would kind of say, hey, they're showing a little trend reversal. Most of the prices are getting above the 10-period moving average. That's a start. You got to make a high in the short term. You make a high, can you actually hold the 10-period moving average and make a higher low? You got to start somewhere. Okay. Now, if we pulled up the semiconductors, again, the stocks that are in the semiconductors have been unbelievable. Ticker symbols, and let me just kind of write down stocks for just a second. I'm going to also put gold for just a quick second. Now, last week we looked at this and we said, hey, is gold really getting above and making a higher high? Not an equal high, not a lower high. Give us a higher high. And today, doink to the upside on gold, and you're also going to see hi-ho silver. Oh, that kind of pushes as well. So what you're now going to notice is a little reversal there. Now, the reason why we're bringing this up is because we said when things pull back in the short term, they make lower lows, lower highs, lower lows, lower highs. You're probably going to see on the bottom there a bullish MACD divergence. Don't worry, you don't have to spell it. But the biggest actually thing is this has been the first time in a while that we've actually been really seeing the MACD go above zero. Okay, what does that tell us? If it pokes its head above the zero line, it probably tells us, doink, we're actually getting above the area of resistance. All right, now let's kind of, so we got a couple things that we could take a look at. Number one, semiconductors. I'm going to go back to precious metals. Now, guys and gals, give me some tickers that we could actually take a quick peek at. So if I said semiconductors, what stocks would you tell me about? Now, I'm going to go back to Market Watch for just a second. I'm going to go back to Visualize. I'm going to bring up the S&P 500. And I'm going to go down to that information technology, the sector, and say, show me, open, please, open the door of semiconductors. Now, if we said semiconductors, just kind of looking in that neighborhood, we could look at NVIDIA, MU. We got AMD, okay? We got Avgo. You got LRCX. I'm just kind of looking at some of those ones that are that green color. And I'm going to bring up also AMAT. Did I miss any? Now, let's go back down precious metals just real quick. If I said precious metals, okay, now, by the way, I'm going to close my blind so no one can see the list behind us, okay? AM, NEM. Okay, I'm glad you're actually saying that. Oh, and let's actually put right here, because last week we brought these up, the STX, the Seagate technology, and we also made mention of last week, WDC. Huh, interesting. So we'll take a look at those two because we brought them up last week. We'll follow through. And I'm also going to bring up just real quick PAS, okay? And I just want to see if there's any other one. Are we missing it? I'm thinking about silver. Silver. Now, if I said I don't know anything about silver, I'm going to go back to, let's say, just real quick, materials, materials. I'm going to go to into metals and mining. And the only thing it actually gives me in that list is these ones. I have NEM already. But the one that I'm looking for, I'm not seeing that, okay? I am in the S&P 500, and I think it's WPM. I don't know why I always forget that. WPM, is that it? No. Yeah, it is, okay? Wheaton, okay? And I'm going to put this here. Now, we already know that when we looked at the indexes, we talked about the VIX, we already know there's some shorter-term pullbacks, probably down to some 30, 50 period moving averages. We already know that the divergences are probably going to be clear. We already know that there's probably going to be some shorter term resistance. So when we talk about indicators, divergence, second would actually be that price is trying to break out in the shorter term. Now I'm going to start with, just real quick, if you don't mind, let's start with WPM, and then we'll work our way left. Now the biggest actually thing is when I look at WPM, there's a gap in the chart. Now, by the way, that earnings, it was on 11/7, 10 a.m. We could check that. But what you're now going to notice is there was a gap in the chart. Okay, that's kind of interesting. Got a gap in the chart. And so we say language like, hey, if the stock breaks resistance, and what is the resistance on the gap down candle that is red? Can anyone actually tell me the answer to that question? What is the resistance on a gap down candle that is red? I gave specific, draw the line here. Where's here? The answer to this question is you draw the line from the open of the gap down. And if the price can actually get above that open of the gap down on a red candle, you got a higher high in the short term. So now what might become the new potential support, 98.96, price is at 101.54. Now, if we measure, just real quick, how far are we off this line? Answer, we're about 2.5%, 2.4%. We can't say language like, we're too high, we're too high. Okay, stop saying that. We said stop saying that because when you get a trend, you get higher highs and higher lows. Okay, it's trending. That higher high is confirmation of an uptrend. Now, I'm going to go back to this wheat and precious metals. The other thing we want to kind of be thinking about is, now I don't know what the options are like, but if I look at the implied volatility, you would think that actually with kind of a recent sell-off in the price, maybe the volatility has been a little higher as well. Well, where is it? Well, it was higher. When it gapped down, that volatility got to about 45%. It's still healthy at about 41%. Now, I'm not saying you have to do this, but there might be some other investors that say, look, I like to sell things. I like to take advantage of other people's potentially, maybe they got out, maybe it was their emotion that caused them to get out, all the above. We're going to go to the trade tab for just a second, and I'm going to bring up that paper money account, WPM. Let's type it in, and we need to get to Google in just a sec. But if we take a look at, let's say, WPM, we're going to look and see what's the volume so far. We talk about the average volume, not where it currently is, okay? The average volume greater than 1 million. And then we go look at the kind of the at-the-money strike, the at-the-money puts. I got about 40 cents there, and I got about 60 cents here. These are not super liquid, okay? Well, at least on the bid-ask spread. When we look at the open interest, it is in the thousands, but if we're probably going to get a fill, we're going to try to get filled at probably 420. Now, let me ask you a quick question, okay? If the investor decided to sell 100, overselling the 95, what are they saying? What's the strategy difference? Well, if you sell the strike, the 100, you are saying, hey, I don't mind to be the buyer of those shares, have a greater statistical chance of being the buyer of the shares at the strike price from now to expiration. It's the at-the-money strike. There's a greater probability the stock could be below that strike, and they're saying, look, I'm okay with owning the shares. That's number one. That's the strategy with kind of selling the at-the-money. If you also say I'm selling at-the-money, you have more of the technical standpoint that you think there might be more upside potential than there is risk to the downside. Not that there's no risk, but there might be less risk because it's trying to reverse. Now, could you be wrong? Yes, you could. And so you need to understand that position sizing still applies. You could think all kinds of things. It doesn't matter. What is the position size? If the paper money account sold one put, while the 100, it's $10,000 worth of stock. $10,000 of stock, $4.20 for premium. We now actually get the confirm and send. And now what you see in this case is, well, you have an obligation to buy the shares at 100. You collect the premium. You haven't made it yet, but you collect it. It's in your cash when you sell it, $420. The max loss is really just taking if the stock went to zero. And what you're now going to notice is there's the commission. So clearly, if you're actually doing WPM, you're thinking that this movement in silver might push back to the upside. Do we know it's going to go to the high? No. Does it have to go to the new high? It'd be nice, okay? But there's obviously some correlation between the silver price and the WPM. Trade number one, what we're going to go ahead and do is send the order, okay? Now, just real quick, I want to answer this question, okay? So if someone said, James, I don't really want the shares as bad as another investor, but I like that premium. I like to trade the statistical likelihood of the stock being above the strike price. 26% chance it could be below that strike price, 74% chance it could be above. Everything sums to 100. So remember that 26, think of that as the conversion, okay? We know if the stock goes up or down $1, we get it. And so we're saying if the stock goes up or down $1, theoretically, how much does the option price move by in the first dollar? 27 cents, okay? We know if we invest 100 shares of stock moves up $1, it could be up 100, down $100. If you have 100 shares and it moves up or down $1. That delta, I like to think of it as a conversion factor. Why? Because if you talk to people that manage portfolios, they talk about it as a conversion factor. Okay, so let's take that terminology. I like it. Think of it, we're converting the currency movement of the U.S. Of the stock into the option price. Okay, there you go. Now let's go ahead and do this. Go confirm and send. We're going to send that, and we're going to see if we can't get it filled. Now in the paper money account, it showed us that it filled at 420. I don't know. If that was real, could it have filled that fast? I don't know. Okay, in paper, it did show. I think we probably got a little 10-cent lucky there, but there it is. Now, I want to just take a quick peek at AEM for just a sec. AEM. And if I pull up AEM, I just want to kind of look and see what we have there. Now, I'm going to imagine, is anyone here a stock investor? Is anyone here a stock investor where you say, James, I like to get in, but sometimes when I see these pullbacks in the shorter term, I'm a little nervous. Now, I'm nervous too, okay? I don't think anyone's just completely just blind, okay? And it doesn't matter if you have $10 million, $20 million, $1 million, or you got 10,000. Nobody likes to typically lose money, okay? Now, so it's about taking a calculated risk. Now, one of the things that I want to kind of bring up just here in this quick example is, let's say the investor, now for those of you that trade stocks, okay, would you say that maybe this is starting to show a potential bounce off the moving averages? Any taker on that, Silas? Thea, Will, Kevin? Would you say, I mean, if someone said, what does a bounce look like? Would you show your friend, coworker, wife, son, daughter, grandson, granddaughter? Would you say, yeah, this is what a bounce looks like? That doesn't guarantee it's going to go up. It's just showing that at this moment in time it's trying to bounce. Now I am on a weekly chart, and these are trend candlesticks. Now, if you kind of look at this in the shorter term, you actually see kind of some higher lows. And then in this case, you see lower highs. Okay? Now, we might even kind of call that a breakout of resistance. Now, I got to say this. First of all, I want to say thanks for filling out the survey last week. I want to share with you one of the surveys that I got that made my day. Now, it wasn't because it was a nice comment. It was a nice comment, but it was how it was written that just really got a chuckle. And I think you should just, let's join in on the good laughter. Now, the comment was last week from one of the surveys was, JB, ya used to annoy me with your exuberance and energy. Got my attention, okay? Person said, what a dummy I was. I actually started to pay attention and realize your genius and fully embrace your passion. Ooh, this sounds perfect. Been a huge fan for months now, and you are key to keeping me on the correct trend and preparing for trend changes. Thanks. Thanks for a great class. Really appreciate your clear explanations and engaging teaching style. Look, if I can help someone actually just focus, it could probably save you years, okay? Now, that was a funny, I just want to say, number one, I read the comments. Number two, that was pretty funny, especially that first line. And that is my teaching style. My teaching style is that I'm either going to really motivate someone to learn about it, or maybe, like this person said, maybe make someone mad. And you can either get excited or mad. Sometimes being mad at first is better than being just energetic about it. Okay, so either way, I want you to get to that decision point. And my job is to take you to that edge where you say, yeah, I'm maybe going to do something for myself, or maybe you decide I'm not. But the whole goal is to try to help you move towards your financial goal. Okay, now, want to kind of share that because I kind of thought it was some funny feedback, and but it was great to actually hear, and thank you for that. Now, what I want to do is on AM, if we went back to the 3-year weekly, that's what it looks like on the 3-year weekly. Now, here's the deal. If I went back to this chart, I'm going to go back to this, and let's say the investor said, James, I'm kind of nervous to get in, okay? I'm going to go back and let's do step one. I'm going to buy the shares of the stock. Now, if I was a stock investor, this doesn't look like anything different so far. Now, one thing is, how do we know it's going to go up? We don't know it's going to go up. So one thing we could do is we could go to single order, first triggers SEQ, and guess where we're going to go? Where are we going to go? Well, what we're going to do is we're going to really go to selling a call. Now, wait, if you have shares and you sell a call, this is a buy right covered call. That's an obligation to sell the shares at the strike price. Now, here's the thing. You're choosing kind of like, you want there to be some chance to be in the money, meaning the stock is above the strike price, because if there's a decent chance it's going to be in the money, then there's a premium. And however big the premium is, you get up to the strike plus the premium. All right. Okay, so, but that's the upside. And that actually does kind of help us if the stock went down a little bit, but it doesn't define the risk outside the stock going to zero. So what we're going to do in this case is we're going to say, look, we're going to sell the 175. Okay, now how do we do that? So step one is we click on the ask price of the stock. Can you do that in the paid money account? Just click on the ask price. Right there. Now, step two, we're going to come down to where it says first trigger sequential or sequence. This is where just selling the call now. Now, when I click on that, now when I go to the bid of the 19 December 175, right there, I'm going to click on that. And if we do that, it's going to be $5.80. Do not brush through this. Oh, I'm just going to click on it, send. If you do that, you're probably going to rub yourself about 10 cents, 20 cents, maybe too thin, meaning the premium is a little bit less. You might get filled faster, but you probably could have maybe squeezed perhaps, maybe a little higher. So we got 580. Now what we're going to do is we're going to come back around and we're going to buy the put below. Now remember, on the call and the put, the deltas are about 30 to 40. They meet the criteria. Now, we could run through this math, and what I'm going to do is if I took a look at this, can anyone tell me what the maximum gain is? What's the maximum gain? 167.40. And what you're going to notice, if the stock goes up, the stock goes down, we got a 175 strike. And we got to ask ourselves, is there a credit or a debit? Looks like there's a credit if we can get filled to that price. So we can make up to 175.25. Where's the 25 cents coming from? It's coming from the call premium and the put premium netted off, pre-commission. Where's the 167 coming from? The stock price. So that could make up to about, let's see, what, $785 if the stock went to the upside. The stock went to the downside, we're going to write 160. Stock goes down to the downside, down to 160, you could lose 740, but you're getting back, let's say, 25 cents. So the downside is about $715. Okay, so 785 up, 715 down. It looked very much like a long call vertical. Now, wait. What if the stock completely just goes sideways? Well, if at the end of that expiration we're at 167 and change, it's pretty much flat. The call and the put are pretty much going to offset each other. Might be slightly ahead because there's a slight credit, but there's no harm, no foul in that case outside that 39 days went by and the stock didn't move anywhere, at least at expiration. So numbers like this look very much like a long call vertical. We're buying the shares, selling the call, buying the put. Welcome to a buy right caller. Now, a lot of times when things go back to the upside, people say things like, well, geez, if I would have gotten in, I could have been up. But they're scared, okay? Now, why do I go over the strategy? Well, people, number one, are stock investors. Number two, they actually might be willing to do a covered call. And if they just take the covered call premium, buy the put, now they might say, look, I've quantified, I've kind of made that there's a floor in place where I don't have to just, oh my gosh, it's going to go to zero. No, the investor has a right to sell those shares from now to expiration at 160. Okay? So now we don't have to, the investor doesn't have to worry about that. Who has that right? The person that buys the put. Is that put indefinite? No. Has an expiration to it. Send the order, confirm and send. Now notice right there, we get 65 cents for the call and the put, note that. And we're gonna go ahead and send it. Now, so trade number one, what was it? What was trade number one? Can you remind me just real quick? What was trade number one? If you just maybe joined us and you're wondering what trade did they do? Well, trade example, number one was really a WPM short put, okay? Trade number two was AM, that was a buy right caller, okay? Now, I do want to take a quick peek at Google for just a second, okay? Just real quick. Before we do that, let me look at NEM, see what it looks like. Looks like AM, okay? Now I want to go back to just real quick. I want to just take a quick look at this. So the one thing is we have those shares at AM, okay? We got that call right there. So this right there. So that caller's there, okay? There it is. I'm going to go back to just real quick at the IRA. I just want to make sure, do we have anything in there? Yeah, no. So this is helpful, okay? So last week we talked about the exiting of protection. Man, paper money count says spank you very much. Exit this protection, the stock bounces to the upside, and now there's just shares. Okay, we talked about that break even last Thursday. Now let's bring up just real quick Google for just a second. Okay, now one of the comments we kind of talked about on Thursday was talking about some of this relative strength. Which stocks look like they have barely pulled back? Which ones that kind of barely pull back? Well, Google, you're going to see about a week and a half ago, they were at, let's say, 291. It was sitting here kind of closer to the moving averages. And what you're going to notice is here in this case, it was at 275. So it pulled back. It just didn't pull back like many other stocks. Now remember, that could be your classic flag. Now, it was me that said this because people would bring up things that look like kind of a little run up and it did actually pull back. But then I would see things like that kind of went up and then it kind of went sideways. Okay? Well, on the left-hand side, that's like a bull flag. It's flagging back. I really called this a bull flat. To me, it looked like an upside-down hockey stick. You can kind of think of it, it is flag-like, but the biggest thing is the flag is stiffer in the fact that it doesn't really pull back that much off the prior high. Now, let's kind of bring up Google for just a second. Where the heck is Pia? Pia, if you're watching this recording, is Pia here today? Where is she? She's here. Okay. Yeah, Pia, where are you? Get off the pickleball courts. You ever notice people that play pickleball? They're always playing pickleball. It's like the most addictive sport there is. That's why I refuse to play it. Now, if we take a look at, let's say, Google for just a second, okay? Let's start with kind of this chart. Let's go back for just a second. Let's go to that chart right there, okay? Now, this chart right here is just really showing your classic trend candlesticks. And remember, we kind of always talked about if we only get orange colored candlesticks in the pullback, what do we call that? What do we call it? We kind of call it the shallowest pullback, okay? So if you only get orange colored candlesticks, that's like the shallowest pullback. It's like, that's it. That's all you got. That's all the bears got. That's all the bulls that are selling. If people are selling, people are stepping in, and it's not really pulling back much. Now, let's go back to the question. How do we know it's going up? We don't know it's going up. We think it's going up. We're about ready to find out. But if we kind of look at this, we can kind of see the pull. Now, you could kind of see the pull is the green candles, and this kind of went sideways too. We saw this before where it only went down for one orange candle, and then it shot to the upside again. And what you're going to notice is we're going to count uno, dos, okay? And now what you're going to see in this case, we had one pullback, doink, 1, 2, doink to the upside. And now what you're going to see is, do we have a close above the high of the low day? Now, this is where usually people say comments like, well, I need some special indicator. Look, you are the special indicator. Your eyes are the special indicator. Can you see the trend? Can you see the shallow pullback? Can you see the close above the high of the low day? And the purpose of that green dot is to really help us confirm what we're seeing on the chart. Now, the color of the candles is really actually help us identify what type of trend is it in. Price, if it's actually a green color candle, price is above both moving averages, and we're not near an area of resistance. Okay? Now, I need everyone to say this correctly, okay? It's not resistance. Say it correctly, please. Resistance. Okay? Resistance. My friend's moving to Paris, so I always joke with them. And anyway, he said I should just come over with him. Who knows? Who knows? Now, what type of strategy would you consider in this case? $289 stock. Now, could people buy shares of the stock? Well, they could, okay? But let's kind of think about this for just a sec. How could the investor trade a bullish trend, but just not outlay maybe as much capital? Yeah, very well done, Thea, Nora, and Jay Richardson. Pia, very well done, and BJ. And the rest of you need more practice. Yeah, Dean does it right as well. Yeah, good. Now, here's the deal. Let's go to the trade tab for just a second. We're going to actually bring up Google, and now we're going to see, Don, do not look below. Close that down. If we look at this, let's say the investor says, okay, what's the volume? 16 million. Now remember, we talk about million shares average daily. They currently have 16. So we're thinking maybe the options might be a little bit more liquid. Now, if we went to, let's say, the at the money strike, bought that on the call side, and then sold the out of the money strike to the upside, we're thinking like a call vertical. Why a call vertical? If you choose a long call vertical over a short put vertical, you're trying to have higher upside potential gains. Still have a loss factored in. You're not trading really probably as much as if you just went over the short put vertical side. Lower credit, max gain, and higher potential probabilities, typically, okay, if we set it up like we talked about. We're going to kind of choose to try to go for a little bit more of the trend, buy, vertical. Now what you're now going to notice is if we go to here, 285, 290. Now, why would we do these two? Well, we're not sure if we are. We're just going to look at the bid-ask spread for just a sec. 15 cents on the 285, 10 cents on the bid-ask spread on the 290, plus thousands in the open interest. Interesting. Why would you choose the 285, 290? Well, choose that if we could only take probably $250 worth of risk or $500. If I said to us that, hey, we could take up to $1,000 worth of risk, Well, probably wouldn't be doing the 285, 290, probably doing the 285, 295. And if we did that, okay, there it is. Unlock that, so it could change that. There's the debit. So if I said, hey, we could take up to 1,000, let's even just say in this case example, we could take up to a risk of $750. Well, we could widen that out. We don't mind widening out. It just better show us a tight bid-ask spread and the open interest. Okay? So we're going to do one contract, Google. Okay? Confirm send. Now, it's in the IRA account. Now, if you don't mind, I'm going to go single account. Now, I know many of you might say, James, I have different accounts. Well, welcome. Okay? There's a lot of people do. We're going to go single account, multiple accounts. We're going to say in the margin account, yeah, I'm going to do one. In the IRA, let's say example given, if I said, hey, I could take up to $1,000 worth of risk, it's going to be two contracts. So if you have those different accounts tied in the same username, those different accounts are going to be listed there. I'll show you where that is again. Click on confirm send, single account, multiple accounts, and now you're just selecting how many contracts do I want sent to the margin, how many contracts do I send to the IRA? Okay. We're now going to go ahead and say, note the break even. The max profit is for the 3 contracts in aggregate, and that cost of the trade or max loss is for the 3 contracts. Okay, not one, for the 3. Send the order. This is kind of a follow through of last week's discussion on relative strength, but just kind of putting some trades to work here. Now, just real quick, want to give us a quick reminder that with what we discussed, it was done for example and illustrative purposes only. Now, remember, you can go to schwab.com, go to learn, and then go to Schwab Coaching. From that schwab.com/coaching, you can go to live webcast and virtual workshop. The next session coming up is Cameron May, and you're going to notice his class is going to be on trading covered calls and short puts. I want to also thank Rachel Dash on the chat. You guys keep her busy, and appreciate that. Always keeping her on her toes. So with that said, remember that with what we discussed here today, it was done for example and illustrative purposes only. Remember that all in investing involves risk. You can never see the future. That's why you actually position size, and you actually try to use a strategy that might try to define risk outside the stock going to zero, if you would consider that. This has been the class on trading with technical indicators. With that said, have a great day. I'll be back on tomorrow morning at 11 a.m. Our focus will be talking about some caller questions that I've actually had, and I want to address those tomorrow. So with that said, thanks so much. Take care. Bye-bye.